Hi guys, I'm Dan, this is Kai. We are the directors at Crescent Mortgages. Today we're bringing you a guide to mortgages for beginners, for dummies. So explaining the process you'll need to go through, what the jargon means, and basically how everything works from the ground up.
Let's get into it.
So to start with, as always, just to confirm that we are not YouTubers, are we? Really?
We're not, no.
We are mortgage brokers. We're qualified and regulated mortgage brokers. So this video will give you a good kind of generic overview of how the process works and obviously explaining the basics, but you will ultimately have to have a conversation tailored to you, which we can assist with. So if you need assistance with your mortgage or you just have some questions or want to run through the initial consultation, just give us a call, send us an email, head over to the website or leave something in the comments and we will do our best to come back to you. So, mortgage for beginners. Just want to highlight that we really are going to try and take this to the absolute basics. If you've never had a mortgage before, you're starting your journey, or there's bits that you haven't understood so far, this is maybe a really good place to start. We're going to kind of explain some of the jargon and the process you'll need to go through, but before we get started, the absolute basics.
Yep.
What is a mortgage, Kai?
A mortgage is a loan secured on a property. And
what do you mean by secured?
By secured, I mean if you do not pay that mortgage, the bank or building society can repossess the property from you.
So that's a mortgage essentially. It's a loan secured on a property by the bank. Once you've paid the mortgage off over however many years, the mortgage is gone and then you own the property outright. But until the mortgage is paid off, that debt is secured against your property. A good place to start is the mortgage process. So the process that you're going to have to undergo, start from the very beginning. So the first thing you should do is speak to a mortgage professional, which can either be your bank or building society or another bank or building society, or what we would encourage is a specialised mortgage broker. And the reason is they have access to the majority of lenders, so they can make sure that you will ultimately get the best available interest rate and the best kind of criteria to match your circumstances. So we are mortgage brokers, as we've touched on. Again, maybe sound a little bit biased, but we do genuinely believe speak to a broker rather than just one. If there's 100 banks out there and you just speak to one, it's probably quite unlikely that you are going to get the best interest rate, whereas brokers have the kind of the tools available to do that kind of shopping around for you. First thing is speak to a broker. Now, when you have that conversation, what are they going to go through with you? What will they do?
They're going to go through your circumstances. So they're going to go through your income, key outgoings, generally credit outgoings primarily, what are you trying to achieve, purchase prices or deposits, and any other quirky bits of criteria that may or may not apply to you. The idea being that once they go through that call, you will know what you can borrow.
If you can borrow.
If you can borrow, what it would cost you, sorts of fees involved in the process, probably a bit of an overview of the process, and ultimately at the end of it you'll get a little piece of paper or a PDF or whatever it may be of a certificate that says I can get a mortgage.
There's a few different kind of terminology that you'll see: AIP, MIP, DIP, decision in principle, mortgage in principle, agreement in principle. It's the same thing. It's not a guarantee, it's just a certificate from a mortgage professional, and you can get that from either a bank or from a broker, confirming that you are good for the money, you should be good for the money.
Estate agents are going to want to know that you can buy the property you're looking to buy.
And that reassures them. If they see that you've got the AIP certificate, they'll normally let you go and view the property and make an offer, which they'll pass on to the seller. Once you've gone through that process, you've got the agreement in principle certificate, you've gone and started your property search, you've found a property, made an offer, it's been successful, then the mortgage process begins, doesn't it?
Yeah, before that point, it's just, can I do it? Once you know you can, you found the property as Dan said, then it's okay, now how do I get the best interest rate, the best lender, the right criteria? That's when you're narrowing down your search to what interest rates are today, and you're going to get into the specifics then of how much is it actually going to cost to buy this property, what's it going to cost?
Which a broker will do most of that for you, won't they? So they'll do the research to find you the best scheme and the best interest rate. They'll confirm what documents they need from you. They'll submit the mortgage application for you. And at that same time, you will also need to pick a solicitor. So the two main parts of the process for you when buying will be organising your mortgage application. You need the mortgage obviously to get the property, and picking a solicitor. They have a really important role in the process, and they will basically oversee the legal purchase of that property for you to become the legal owner. The solicitor has a lot of work to do. Your broker will normally recommend a solicitor to you, or you can shop around for someone yourself, but don't just go on the dirt cheapest solicitor. You need to find someone who actually is going to get the job done and do it properly. So trying to find a balance of obviously good value, but also offering a high level of service. The legal work and the mortgage application will normally kind of start simultaneously, won't they?
Yeah.
They'll start at a similar time. The mortgage, on average, will be agreed within a few weeks, won't it? But it can vary from person to person. It can take a few days, it can take a few months, but on average, a few weeks to get the mortgage agreed is fairly typical, providing there's kind of no hiccups or unexpected issues. It's actually the legal work that takes a lot longer. So I think this is a misconception. People think it's going to take 3 months to get your mortgage agreed. Hopefully, normally it won't. It's the solicitor and the legal work, the work they've got to do in the background, the communicating with the seller's solicitor, additional searches and whatnot. That's what takes the kind of the longest, really quickly for 20 seconds. So to get your mortgage agreed for pretty much everyone, so it's the 3 hurdles. So first one is the credit check. The computer is going to run a credit check on you. So again, have the conversation with your broker beforehand if you have any concerns about your credit, and if they think they need to, they will look at your credit file first, so you don't start running multiple credit checks when actually there could be some issues that we're not aware of. They'll do a property valuation, so they'll value your property. We do actually have another video coming out in more detail on kind of valuations and surveys, which you can watch, but they'll do a mortgage valuation to make sure they're happy with the condition of the property, because as Kai said, the loan will be secured on that property, and if they had to repossess it, they need to make sure that they're happy with the condition and the value of the property. And the other one is the underwriting, so that a human will normally look at the application, make sure you meet their criteria, make sure you meet affordability, there's no other issues in the background that they're concerned about. Once it's got through those 3 checks, as Kai mentioned, you then get the mortgage offer. I think that's kind of the mortgage process. Most of what we're about to go through now will be covered in the initial consultation that you have with a broker. So I know we've mentioned that a few times, but that is really important. That's the point where you understand how much you're going to be able to borrow, what's going to be achievable, how much you're going to be paying, and everything will be tailored to your specific circumstances. So that's where you are going to get the specialist advice rather than what we're given today, which is a bit more generic.
That's the most important point, I think, of this video, isn't it? It's that agreement in principle.
Exactly.
It's that bit. It's all about making sure you get that conversation done and done well. The rest of it is just a process.
Essentially, the video that we're making here now, a good broker completing a thorough consultation should kind of cover everything we're going through today, but in more detail, because it will be tailored to you. So I guess some of the key things that will come up in that initial consultation. The first thing would be kind of basically the deposit and costs that you're going to need to cover.
And that's the one, I guess, if you're watching this video, you've probably been doing your research already, and that'll be one of your biggest hurdles. Save a deposit. Save a deposit. It's very common for people buying. Minimum deposit generally is 5%. It varies a little bit with the market, but 5%.
And not all lenders accept 5%.
Not all lenders, no. And there are limitations on smaller deposits for different types of properties, potentially a flat. You sometimes need a bigger deposit,
New build
sometimes
properties,
don't.
sometimes need bigger.
So a few variations again, but generally speaking, 5% is your entry level deposit. Every 5% of deposit you then put down, you get a better rate generally, and normally slightly more flexible criteria as well if you put down slightly bigger deposit.
With a bigger deposit, they can be willing, on top of giving you a better interest rate, credit checks can be a bit more lenient. So you might find that you don't pass a credit check with a 5% deposit, but maybe you do with a 10 or a 15% deposit. They can sometimes be more generous with the bigger deposit as well, whereas with a smaller deposit, the number of times your salary they're willing to go to could be lower. Like I said, it's done in 5% increments. So if you put down a 12% deposit, it's no different from putting down a 10% deposit. You'd only see improvements from 10% when you get to a 15% deposit.
Yeah, in terms of criteria and rate. Obviously, if you borrow a little bit less, then it's a bit cheaper. So if you put down 12%, not 10%, it's a bit cheaper, but no different in terms of rate or criteria. I
guess some of the jargon, which again, you may have specific questions about this. So a couple of terms you may have seen. First of all, LTV.
Yes.
What does that mean? Loan
to value is what it stands for. The portion of the loan I always get this one mixed up when I have to explain. You go.
It's the percentage of the property that is mortgaged.
Yeah.
So if you buy a property for £100,000 and you put down £10,000, then you're putting down a 10% deposit, which means that the mortgage required is 90% of the property value. So the loan to value is 90%. And if you put down a 20% deposit, your loan to value will be 80%. and so on. So it's basically that, yeah, the mortgage is a percentage of the property value. When you buy, it's calculated, it's very straightforward. It's just your deposit. If you put down 10%, your LTV is 90%. When you come to remortgage in the future, it will be based on the property value at that time, which again, you probably don't need to worry about this too much at this stage, but that's how that it would be calculated, based on your equity at the time. So if your mortgage has come down where you've been clearing it off and your property value has gone up with, let's say, market growth, then you'll have more equity at that time, which means you'll have a lower loan to value, which means it might open up better interest rates and better criteria. Couple of other bits of terminology, which I think these two get confused. Term and scheme.
Yeah, people do confuse, yeah.
So, yeah, do they?
Yeah, I'd say they do. Yeah, I'd validate that, yeah.
Your term
Yep.
is the total number of years that you spread out the mortgage.
Like 2 or 5?
No. You should know better than that, actually, or you just teared me out.
Just tearing you up.
Good. If you spread the debt over 35 years, your mortgage will be calculated over a 35-year term, and at the end of the 35 years, you're mortgage free, then you have a 35-year term. Now, how does that compare to scheme?
Scheme or product.
Or product or interest rate. It's got, again, a few different terms to see.
That is your preferential kind of interest rate that you've picked. So when you're applying for your mortgage, you'll pick an interest rate which will normally be valid for 2 years or 3 years or 5 years, sometimes longer.
You can choose and have that conversation with your broker.
Exactly, and the idea is then after that 2, 3, 5 years or whatever the length of scheme or products that you've picked, it expires and you generally go on to a higher standard variable rate or you remortgage. And again, brokers should warn you of that, make sure that you do remortgage when you should, and kind of walk you through those steps. But yeah, the scheme or product or interest rate is for a shorter period of time, and you'll have multiple schemes, products, etc. as your mortgage term goes on.
Let's say you take out a 35-year mortgage term and you initially start on a 2-year fix. At the end of that first 2-year fix, you will then organise a remortgage where you shop around for a new scheme, whether that be another 2-year fix or a 5-year fix, depending on the market and your preference at the time. So when you come to remortgage, there would then, because 2 years have passed, you will then have 33 years remaining on the term. It's dropped down by 2 years, and you would then select another scheme. And you'll do that every few years for the duration of your mortgage term. You're not committed to the term, are you? So if you take the mortgage for 35 years, you are completely within your rights to try and overpay on the mortgage to clear it down quicker.
Yep.
Or when you come to remortgage in the future, if you think you can afford it, you can reduce the term further. Yep. Now, naturally, if you reduce the term, your payments will be higher because you're spreading the debt over a shorter period. But it does mean that you are going to pay less interest overall with a shorter mortgage term because you're ultimately paying interest for a shorter period, and you're going to be mortgage free at a younger age, which I think is a big goal for a lot of people, isn't it?
And that's quite a big part of the conversation you'll have with the broker or whoever you're taking your mortgage through. Mortgage term, justifying how long it is. You're trying to get that balance between as short as you can so you pay less interest, but also not to overextend yourself on your mortgage payments. And as Dan said, that it is a flexible term so that ultimately you don't have to pick it now at in your 20s or your 30s and commit to 35 years. You might be able to get that shorter. You may extend it at different points in your life. It is flexible, but it's a big part of the conversation.
First time buyers, it's really common for them to spread the mortgage over as long as possible to keep your payments down whilst you get used to them. So a 30, 35, 40-year mortgage term with some lenders. And like Kai said, you're not committed to that. You can reduce that, quicker in the future. But, in theory, you could take your mortgage as short as you wanted within reason. A lender would give a 10-year mortgage term or a 15-year mortgage term, but for most people, the mortgage payments are just going to be too high because, you're kind of condensing the mortgage over too short a period. A few final kind of bits of jargon you may see. So, fees, arrangement fees.
Yeah.
The arrangement fees are the main fee that will come up on the mortgage. You will have separate fees to your solicitor for the legal work, but for the mortgage, the main fee that comes up 90% of the time, if at all, is the arrangement fee, isn't it?
Yeah.
What is an arrangement fee and what does it do?
I guess
what do you get for your money?
Quite a lot, arrangement fee, you might also see it product fee, lender fee, there's a few different things, but first and foremost, it's charged by the lender. They're attached to the products by that lender. So generally speaking, lenders have a lot of products. Their lower interest rates will have a fee, often £1,000, can be more, can be less. Generally £1,000 for a low interest rate. They'll also have another product that would be a higher interest rate, but no fee. Depending on how much your mortgage is, i.e. how big the mortgage is, will depend on what is better of those two. And that's, again, part of the calculation that your broker should do with you. You know, if you're saving £100 a month for 2 years and there's a £1,000 fee, that makes sense. If you're saving £10 a month for 2 years, for £1,000 fees, yeah, it's not worth it.
Yeah.
And that's in very simple terms, but that is kind of the calculation. That fee, importantly, isn't one that you necessarily need to budget for. It can be added to the mortgage generally. Some of them are non-refundable, some are refundable. So again, that will be a conversation you have with your broker.
If you don't go ahead.
Yeah,
if you go ahead,
exactly.
It's not refundable, you have to pay it.
Exactly. So get into those conversations, I guess, specifically with you or your broker will get in that with you. But importantly, it's not necessarily something you budget for.
No, because it can normally be added to the loan. And I guess the main thing to summarise is don't be scared of arrangement fees. Your broker will only recommend you go for a scheme with an arrangement fee if the interest rate is low enough to warrant paying that fee. In a way, they benefit you because you get the choice. You go for the higher rate with no fee or the lower rate with a fee, and it just depends on your particular circumstances, most specifically how much you're borrowing.
Yeah.
So again, your broker will kind of talk you through that. Couple of other fees.
What is from fees?
Couple of other fees that might come up. So again, we have made another video on this, so just very briefly, valuation and survey. So
yeah.
Mortgage valuation, as we touched on, is a mandatory part of the mortgage process. They'll send someone to the property normally, or they might just do a drive-by or online valuation just to make sure that kind of, you know, the property is in reasonable condition and you're paying a fair value for it. That's normally free, or if lenders do charge for those, it's pretty minimal, probably a maximum of £100. Survey is a bit different, so you can opt for a more comprehensive valuation, generally called a survey, and it's not a mandatory part of the mortgage process. You do not have to have that done at all. But as you're the one buying this property, you're taking on the responsibility, and if there are any issues with the property, it's your problem. You might choose to pay extra to organise an additional private survey, just to make sure that the property is in reasonable condition. And if the surveyor missed something, there could be recourse. It could come back on them. You've kind of covered yourself a little bit.
Yeah.
You don't have to have it.
No, we have a video on that. I think we have a slightly older one and a newer one, if not already outcoming, which will explain that if you want more on surveys.
Yeah. I guess final bit of jargon, protection, life assurance, insurance. There's a few different types. Essentially, there are two main types of insurance that you should be looking at in line with your purchase. The first one, this is mandatory, it will all be checked by the solicitor to make sure you've got it in place, is your buildings insurance on the property, home insurance, buildings and contents, whatever you want to call it. That's nice and quick to organise generally, shouldn't be too expensive. You can obviously shop around for that before you exchange contracts, but the solicitor will need to see that you've got that in place. The other one, which again is kind of, we refer to as protection in the industry, but it's essentially your life and illness insurances. This is something you have to take seriously. It's more important to some people than others. I think naturally, if you don't have any private cover at the moment, or if you've got kind of dependents or kids or anything in the home, then you definitely need to look at this. And it's basically to make sure that if something happens to you, you either pass away or you become ill, you and the family can maintain your mortgage or clear your mortgage and pay your bills and food costs and that kind of stuff. So something that a lot of people understand the importance of, maybe some people don't take as seriously as they should do, but again, your broker will assist you with that. They'll talk you through the different types of cover, roughly how much it costs, and you can start to work out a budget that you're comfortable with.
I guess important to, probably just to add to that, this is for the whole mortgage term. So again, if you are looking to buy your first property, you might be in your 20s or maybe your 30s. This isn't covering you just in your 20s and 30s. As Dan said, the mortgage term often is 35 years, maybe 40 years, 30. Often mortgages these days are going up to 60 or even 70. So yeah, you're thinking a bit bigger picture, I guess, aren't you?
You're not committed to having that cover for 30 years. If you ended up selling the property or reach a point where you no longer needed the cover, you can cancel it whenever you want. But the idea is that you can lock in a premium where you're young, and that premium will be guaranteed and will not change for the duration of the term. So where people say, actually, I'm young, I'm healthy, I don't need cover, actually that's the exact time when you should take it, because you're rewarded for being younger, and you will get a better premium. But again, we'll kind of cover that with you in more detail when we speak. So I guess to summarise, everything will be tailored to your circumstances specifically. So this is kind of a bit of a broad overview. So we strongly advise the first thing you should do, go and speak to a broker. Obviously, we encourage ourselves, but no pressure, just find yourself a good broker, have the initial consultation, they'll run through the relevant questions to obviously start to work out what's going to be achievable, and that will put you in a good place to then start your property search. As mentioned, if you need to contact us, just get in touch, or leave a question in the comments and we'll do our best to come back to you as soon as possible. Talk soon.